So steps. We have to think about the exposure, nature of exposure. So in case we have only revenues in the foreign exchange rates, then what is the desired change in the currency? So if you have only revenues, then the depreciation. Or currency, so in this case, the euro. If you have only costs in the foreign exchange rate, then we are absolutely interested in the appreciation. Double P. Yeah. And for us, right now, this is the case. So we can say that we have only cost in foreign exchange rate. At least my scenario has only cost in the foreign exchange rate, and that's why the appreciation of the currency is desired. Then, next step, what is supported by historic trend? So is this appreciation of my currency is desired, then is this happening? So let's look on the data and let's see that is there any trend, long-term trend. So if I'm looking on Hungarian forint versus euro for the last 30 years in this nice Polish website, we can see that it's not appreciating. So in this case, even we could fit a linear line on it, which is terrible. But here we cannot see any trend. So it's completely widely fluctuating in both directions. Maybe we can, if it would be a linear trend, it would be completely a horizontal trend line, and it's not going up, not going down. So we can see that so it can go up and go down. So we have no idea. So if we are checking that the forecasting macro model was not significant, we did it and it did not end well. Mostly the problem was that, okay, the fit was efficient on historical data set, just we are trying right now to build up macro models after 2 years of coronavirus and in a state of rising inflation. So, and the entire data set was focusing on past data where it was not the case. So it was, this VAR model was nice and sophisticated, just it was not working. So simulation, it can go both direction. So it can appreciate, it can depreciate. Okay. And also the futures market data. Yeah, this is so from the Reuters database, or now called Econ database, we were able to collect that for the next 3 years the market expects so euro will appreciate further. Okay. So which can be useful for us, because in this case we can say that, okay, that was, oh, let's copy it here, because and we can say that this spot rate, so we are seeing that, okay, it's, and I cannot see why it's, okay, right now the entire market is a mess, but okay, let's not comment this. So still we can say that in this case the best case scenario can be applicable. So, and in this case we are really happy about this, because it would mean that right now, since the best what we have is the futures market expectations, so the entire market thinks that the currency will appreciate. So this is great news for our company. Okay, then the next thing is we have to determine that still what is the exposure here, because after we calculated the exposure in US dollar, then we have to determine that is this relevant for us or not. So fourth point, FX exposure in US dollar. We know that this is related to the number of engines. So in this case, overall engines needed. Then this number plus this number. And then we can have million US dollars, and then we can see that the total exposure in US dollar, now we can move away from this one, is this plus this one, this and this and that. So right now what we can see, that 2.5 billion US dollar is the exposure for the next 5 years, with the current rate of launches and orders and reusability and so on. So I think that can be quite significant. So maybe we can say that, yeah, it's okay. Still we would calculate, or we could calculate that what is the ratio of this money from EBITDA or something like this, but still we cannot say for 2.5 billion US dollar that it's not relevant. So I think it's obvious that we don't need further calculations to say that we have to deal with this. Okay, so 6th point. What kind of exposure is this? Because according to the Jeff Madura International Financial Management book, there are 3 types of different exposures. So in this case, I mentioned already that this is just related to the annual report. That you know that when they are doing this, then usually they are picking some date for end of March or something like this, when they are evaluating or re-evaluating all the exchange rates, and accountants, people in accounting, they are doing their magic, and so it's an accounting or reporting phenomena. So for us, it's translational exposure is not relevant, so it's not financial. We cannot hedge it efficiently with options. Maybe we can write in also the annual report that we were doing this, and we have to write in, but from risk management point of view, it's irrelevant. So we don't have to deal with that one. Then transactional exposure. So it means that when we are buying the engines, so we have to pay in USD for each engines when we purchase them. So this is financial. So this one is relevant for us because this is when cash flows and are affected by the exchange rate movement, because the third kind of exposure, so the economic exposure, when our suppliers and clients are affected by foreign exchange changes. It's maybe we can consider that okay, it can be related to marketing or and other non-financial branches of the company, but it's still we cannot have efficient financial tools. Okay, we can change our prices, but other financial tools to mitigate or to manage such a risk. So otherwise we can say that we have to deal with the transactional exposure. So okay, and seventh point, how can we imagine? Okay, describe. This is necessary because we have to determine that when, if we will do the hedging, that when should we purchase the option, when should we pay the fees, and when will it expire, so something like this. So that's why we have to decide that how this transactional exposure happens. So we can say that at the beginning of each year we know the number of engines, we know the desired engine number, and we will purchase them. Immediately. Yeah, just in this case there would be. Oh, okay. It simplifies our case. So let's say that immediately as spot rate. Finally, we have the final step. Okay, but what kind of hedging strategy can we select? And we can do this if, so first of all, I mentioned so many things, but first is diversified currency portfolio. Can we have this? No, because we have only two currencies, so. What we have, so, and also you can remember several weeks ago, when we were analyzing these currencies, yes, they are here, and I was playing with correlations, and I remember that I was saving it somewhere, or not. Okay, so anyway, that we can see that diversification would be really hard in currency markets because first of all, correlation is time variant, so it changes in time, and mostly currencies are highly correlated with each other. So that's the second problem. So that's why not just we have. If you would have multiple currencies, still it would be nearly impossible to create a well-diversified portfolio with zero standard deviation. Maybe if you are adding some exotic elements, which is not correlated, so maybe we should add gold, maybe we should add cryptocurrencies. We had a paper like this one, and it's mathematically it's possible, just you have to rearrange the portfolio so many times that it generates too much transactional cost. So we can say that no, we are not doing a diversified portfolio. Okay, other cases of no hedge, that the size of exposure is irrelevant. And we can say that's not so. $2.5 billion US is not. Cannot be considered as but if your company has absolutely no US dollar exposure, then for you no hedge strategy will be immediately an option. Then diversified portfolio size, and also supported by market trend. So we are saying that appreciation would be nice, and which trend is this right now, even if you are not looking on the overall time period, but this is going this way. In this case we have much more like a depreciation, so okay, we were not writing this one, but we can say no market trend. What futures market are expecting? Appreciation. So maybe it's greenish. What is this? The only thing what I was able to see that okay, maybe we should do no hedge or total hedge. So in this case, what will happen? That the management and the owners of the company or the investors will sleep well. So want to sleep well, but in this case it will be expensive. Okay, now we should consider the level of expensiveness. So let's compare, because practically, okay, we were saying pro and contra here, but we need numbers. So option fees. And we can have this partial hedge. Buying options. Buying options in the case of extreme depreciation. Yeah, just the problem is that right now we cannot have this one, because if we would compare past data, then we would be able to evaluate that, okay, when crisis events happened. So in the past we can see that, okay, this is when the company is supposed to purchase options, and this is when in this year. Not because it's calm, but if we have future forecasts, I think it would be not reliable to say so. That if we are looking on this spaghetti of of this data, that okay, hypothetically this market was absolutely unhappy here, so it had a crisis, but others were maybe completely calm. So that's why this kind of simulation is completely useless to evaluate. So we can't evaluate it on simulated data. We can evaluate it on past data, but I think it will be really simple or elegant to compare these two. So let's abandon this idea and focus on this and that one. And of course, already we have the data for what happens under no hedge. So this is everything what we have here, because we calculated last time the no hedge scenario. It's supposed to be in the middle. So this is then where all the fluctuations can happen, and also we have the value here. It's good because it's already a present value. This one, it would be also nice to convert everything to present value, because in this case we can make real comparisons, because option fees will be also calculated in present value, so that's why. Okay, this will appear at the end of the year. Do you have there is the interest rate, and we have to fix everything, because if I roll it down, then it would deviate from the interest rate. So interest rate must be this F4 dollar marks. Okay, and now we can have different present values for the profit under no hedge. Then we need option fees. So if we are running this total hedge, So what can we say? That okay, if we are running the total hedge, it means that no foreign exchange rate change can be considered. So let's take this one. This present value, and we have no alternate cases, because right now we are just fixing. Okay, but what was the exchange rate at this case? So it was just 1. Which seems to be ridiculous. But we already know one thing. From here, that we have this annual expenditures. So okay. Okay, done. Cool. Okay, so we have to decide what is the spot rate, what are the spot rates. So the spot rates will be, we have to pick one. Possibly. Then should it be the expected? Should it be the worst case? Should it be the best case? Let's have the expected scenario spot rates. Right now we have no idea, but somehow we have to evaluate what is happening here. So let's refer it back. Because if we are changing the underlying data, we have to do it only once. Target rate. Let's be lazy. Let's say we are fixing everything with 1 US dollar to euro exchange rate. We don't want to have some overcomplicated stuff, and because it will result this kind of cash flows. And also, when we have to have this kind of we need volatility. Yes. So we need the volatility of the market, and in this case, we have volatility data, just I did not made or saved it. So I should modify the simulation. In this case, we will have a nice simulated HT. The HT is variance, so we have to take the square root of it, and it will be standard deviation immediately. So actually I just have to save it, and that's all, I think. Okay. How does it look like? So yes, there are some unhappy universes with with huge volatility, but others are quite similar. So now we just have to take the same stuff with some modification. Simulated standard deviation. So we can take it's not the data, same, it will be called as HT, and we have to take the square root of it, so SQRT, the square root, and then just changing things, and this is the 2. Second. Oh, we don't have error message, which is good. Then let's see what happens. Whoa, with volatilities. Is this looking like this? But why is 5 of them? It's supposed to be only... Yeah, because we have 5 years. Okay. Yes. Okay, so whoo. But it's still too much, because we have 5 years, but 3 different scenarios. So I miscalibrated something here. Not, or maybe the plot was not right. So we have the expected scenario already, and we can see that yes, we have different volatilities, so for each year. Let's paste it, let's change the stupid decimal points to decimal commas to make it edible for Excel. And now we have volatility standard deviation. Okay, we have the time factor, time in years, 1 year, 2 years, 3 year, 4 year, 5 year ahead, and we need interest rates, interest rate at home. Okay, we already have this interest rate, so let's keep them. Fixed income, and bonds, and government bonds, and curves, and we are talking about EU. So here we can see that, okay, 1 year ahead, the 0. Oh god, maybe we should delete this one. 3%, then 2 years ahead, at least it's positive, 0.128. It's terrible. 0.3. It's so biased by central banks that, and 0.63. Yeah, even for 4 years we have it's nice, just I can't see it, but Okay, and in the US we have to dig up the same thing. So it's also completely unrealistic, but at least it's a bit better. Okay. Half. Then seven. Of course, these are dynamic numbers, so they can change in any minute, but and we don't have anything for year 4. Noise. Let's use a sophisticated formula to find this one. Okay, and now we have everything for options fee calculation. So we just have to add the numbers here. So this is a black source calculator. It would be much more precise to call it as Garban-Kohlhagen, but anyways. And this one is making all the calculations for us. So spot rate, it's coming from here. Strike prices, this one. Volatility, this one. Domestic interest rate. This one. Foreign interest rate, this one. Time to maturity in days, okay, is 1 year. And then it gives us this call price, which is this number with the number here. And we can do the same thing by just updating this one. Length of this one, so I have to redo it because now I was just creating 1 year ahead scenarios. So let's copy and paste everything again. It was a wise decision, just not careful enough. Yeah, we can see that as long the option is, the cheaper it gets. Okay, this one is updated. So now we can see that, okay, those are all the option fees. So price of hedging with caps lock. So this number multiplied by the exposure here. Yeah, just we have to multiply it also with millions. So altogether or beauty sleep would cost the company for 150 million euros. So this is what we have to consider, that adding this number, sorry, taking out this number from here, so this minus this, versus all the possibilities. So if no changes are happening, and we are lucky, so in this case we are lucky, without any changes, then this one is better than the hedged opportunity. If we are absolutely lucky, so changes are happening in our favor, then we can make the double amount of money. If still expected thing is happening, then it's still better. So only the worst case scenario what we can avoid. So in this case I cannot say that it's a good opportunity to fix all the exchange rates ahead,